Hello and welcome everyone. Welcome to our end of November live stream. And it's a very interesting time for us to be having this live stream when we are coming back from a very sharp correction and the market is seeing a little bit of recovery. And a lot of investors right now, Siddharth, I think are asking us that is it the right time to invest? Is it the right time to actually add more? So that is what we will try to discuss in this session. And obviously there are a lot of nuances to it, right? It's not a simple answer, but we'll try to add a lot of context from the economic front.
Absolutely.
Yes. Should we wait for a couple of minutes or should we get started with our presentation?
I think we can get started. People seem to be coming on right now.
Okay. Right. So I have a quick presentation here for a November update. So we will start by talking about the performance and the numbers, right? I think across our PMSs and our small cases, we've done pretty strongly. Now on the PMS, we've completed 15 months, right? 15 or 16 months. We started in August of last year, right? And our strategies, all of them have been very robust. Factor strategy, is the best performer. Alpha has also really picked up, even though it saw some correction in the last month, and momentum also has been doing pretty strongly. So, Siddharth, to those who do not understand these strategies, would you like to introduce the three of them?
No, absolutely. So I think we've got three strategies here. The first one is the factor fund. It fundamentally looks at a multi-factor approach, which is where we take a look at, let's say, momentum, quality, value, and a couple of other such parameters, and then that's the sort of gist of the overall strategy here. The sort of good and the bad of the strategy is essentially that it's a strategy that does really well across time periods and time frames, because we're able to select different factors that are going to do well in the current scenario or in the upcoming market changes that are potentially happening, right? When we look at, let's say, momentum or alpha, that is typically a single factor or a more concentrated factor approach where we're looking at either the momentum as a factor, along with other sort of variables that look at, let's say, higher quality assets and stocks in the market. The fundamental difference between the two naturally is that the momentum fund typically looks at about 20-25 stocks, and we're able to do a bit of hedging in it as well. Whereas the alpha fund typically looks at about 10 stocks, and the idea is you're taking a very concentrated bet. You're getting rid of all the diversification, losses or benefits that may come with market changes that happen typically. But it's a strategy that does really well when the markets are pretty strong and the markets are sort of in that sort of bullish phase.
Yes, that's a perfect explanation, right? And what we see is that many of our investors, so we have majority of our assets in the factor fund, right? And second is our alpha. So our factor fund right now is around 210, 215 crores, and alpha fund is around 80 crores in aggregate. On an aggregate level, Siddharth, this month we are closing at 350 crores, right? So it's a good number to have with only 17 months, right?
Yeah, yeah, absolutely.
Yes. And we're open to new investors and very excited to get all these new people who are interested in the quant concepts, right? So see, with right research we invest in a quantitative basis, right? So you will hardly tell us, see us telling you some story, or if we are telling you a story, then that story also changes after some time, because we tend to be data driven, right? So that is
Yeah.
what we are not biased towards anything or any scenario or any factor. We tactically shift our allocation between, not very rapidly, but uh, slowly, or as needed. And that is what the benefit of a quant strategy is, that we are giving you unbiased view, which changes with the changing market conditions, right? So now let's go over the performance, right? See, I think the factor strategy has done, close to 1% last month, which is quite good given how November was, right? So November we saw sharp declines after a bad October, and things were not looking really good till the middle of the month. But the factor strategy has seen a strong recovery, and it has ended up positive by close to 1%. So I think that's great for the strategy. And even see, even if you look at October and November, right? So that what's very interesting here is that we have not gone to cash, right? We have not done any sort of risk mitigation in that sense that we are moving out of the market or doing anything like that. But still, our strategies have done quite a bit better than the benchmarks, right?
Yeah.
And a 3% correction from from October to now, and then recovery. So I would assume only a 2% correction from October is not a bad thing to have in such a market, right?
No, absolutely. I think the markets are quite volatile,
Yes,
especially in November. So it's
yes.
pretty good.
Yeah, and then you have our hedge strategy. I mean, we call it momentum fund now, and in the momentum fund again, it has done like a percent up in November, and October was even better for this. So it only saw like a 3.5% correction. So again, it's been pretty robust, and I think there were a lot of queries about people. They thought that our momentum fund is lagging the others, but as you can see, that past 5-6 months, it has very consistently beaten the benchmarks, right? So
Yeah.
again, an interesting strategy to look at. Our alpha strategy had been doing extremely strong since August, September, October, but in November, I think due to concentration, and we had one fertilizer stock that a global fertilizer stock that saw some correction during November, which has led to a slight decline in this particular strategy. But again, it's a very minor decline, and we expect in the longer term to for it to really pick up, like the strong performance that it shows. Now let's come to on an aggregate level, you would see that two of our strategies have beaten the benchmark factor and momentum. They've done really good last month. Quite exceptional that we're ending November positively. Alpha is slightly negative because of the concentration in a particular stock that has seen some correction, but we have rebalanced and we have sort of reshuffled our portfolios to make up for any changes that are needed. Uh, okay, Siddharth, can you please mute it? Your keyboard is very loud.
Oh, sorry, my bad.
All right. So let's come to how the allocations are changing. So if you look at the allocations in our factor strategy, you would see that the allocations have really shifted over the last 1 year. We have right now major allocation in the finance and fintech space. So you're seeing capital market stocks do really well. You're seeing fintechs do really well. So those are close to 25% of our portfolio. Along with that we have a few e-commerce companies, right? We have consumer food, we have few fertilizer linked, a little representation from IT and linked companies, and lesser allocation to, let's say, power or construction, right? In terms of our market cap split, you would see that small and mid caps have a larger allocation, but if you go inside it, what you'll realize is that these small and mid cap that we're holding are the larger ones, right? They're not the very small and mid cap. These are the large small and mid cap, so potentially stocks with more than 10,000, 20,000 crores in market cap, right? In our momentum fund also, you'll see pharma here is a large allocation. It's close to 20%. And then you have a little bit of finance and uh, linked sectors, and there's a lot of consumer durables and telecommunications here as well. In our alpha strategy, again, you're seeing strong momentum in pharmaceuticals. So you have a lot of pharmaceuticals, you have retail, right? And you have consumer durables. So what you are noticing is that what we are investing in right now is very defensive, right? So we're not very, very highly allocated into super cyclical industries right now, which are linked to economic growth. What we are betting on is consumption plays and retail plays and defensive plays that are linked to India's robust growth story and strong consumption story. And I think this shift has happened depending on the data, and we actually expect that this would continue for at least 1 or 2 quarters before things change, right? Okay, so let's come over to the big question, that is the correction over? Are we done with the correction? So there's a lot of nuances to it, and I'm sure majority of people will answered that maybe not, right? Maybe not, because there are a lot of things happening in the market. And just last week, we saw big numbers come out which shocked us all, right? But let's start by looking at the factors, which is our building blocks, right? So if you look at factors, what you'll see is on a weekly level, all factors are doing their quarterly and monthly numbers, right? So while last quarter, last month have been pretty bad for most of the factors, in the recent times, you're seeing in the last week they seem to be making up for a lot of that, right? And we're seeing stronger recovery happen in value and momentum, and across the board all factors are doing positively, but stronger recovery is being seen in momentum and value. But the most consistent performer over the last 3 months, last quarter, month or week, has been the quality factor, right? So I think right now there seems to be a large cap bias that sort of people are building in, even though we are seeing still a lot of interest in small and mid caps. But yeah, quality as a factor seems to be very, very consistent right now. Now, what we also do and we tell our investors is that we invest based on the fear and greed index, right? Wherever there's a lot of fear, we'll buy more. Wherever there's a lot of greed, we will try to sell more. And what we have seen since October is that the market has pretty consistently been in the fear zone, right? Like in the fearful zone. And in the last 1 week, we are seeing that uptick happen where, fear seems to be subsiding, and there seems to be a little bit of greed that is building. So, which is a signal that there could be a rebound that is happening for sure. In terms of our longer term regime, so well, like we tell you that we invest based on the regime, so we take the risk based on the regimes in the market. And what we can see is the market has been in a negative regime for the last quarter and continues to be so. We have put risk limits in our strategy, so we're taking lesser risk than what we would take in a bullish market. And finally, I think even on the market cap front, so a lot of investors will ask us that why do you have small and mid cap allocation? Why are you not going to large caps? So we again have a model that sort of tells us is this the right time to go to small and mid caps or large caps? And it's still hinting that small and mid caps are interesting. So we're still allocated, but yeah, we are seeing the larger stocks getting more allocation instead of the smallest stocks, right? Now let's come to the bigger number that came out this last week was, and which has shocked a lot of people. I think this came just after the market close, right? I think on Friday. So we have not seen the big reaction in the markets from this. But India's GDP has declined to 5.4%. So after, you can see after almost 8 quarters, we have dipped below 6%, right? And this is a big, big shocker because India, you know, in an automated fashion tends to grow at a level above 6%, but we've seen a decline happen from that 6% number, and that could be a worry for the economy or a sign that there is some slowdown that is happening. Now, will we continue to grow below this, or we'll see recovery from this? That's the second question that we have to answer. But yes, if you look inside the GDP numbers, what you will notice is that this is the September quarter, and most of the deceleration that has actually come from the manufacturing space. So while you can see, construction, financial services, all of that are pretty robust, but your even agriculture has grown, in fact, but your manufacturing growth has really slowed down, and that is the reason why we are seeing that the GDP has come down. Now, why has the manufacturing growth slowed down? Probably because it was election season. The government has not spent the money that they wanted to spend, so there hasn't been any government capex because of the international tariffs that might be coming. We've seen just yesterday Donald Trump has come out and said that he's going to he's going to put 100% tariff on BRICS nation if they come up with their own currency, which they have been planning. So, the government might be preparing for those tariffs and not spending that much on capex, even though they're spending on agriculture and welfare. So that might be one of the reasons why the GDP has slowed down. But the bigger question is that is this the bottom, or will there be any more stress ahead? So let's look at some more numbers. I have a lot of charts in the presentation, so Please do let us know in the chat if I'm it's getting a little bit boring for you. But yeah, so see, what we're seeing is that the real GDP has slowed down, and the patterns have changed to what was happening before COVID, right? So before COVID, what we saw was that consumption used to outperform your um capex, right? So uh, we were seeing more growth coming out of consumption spending rather than on the capex spending or the capital expenditure, and that is the trend that seems to be again forming after COVID. And this is a shift. So we sort of seem to be going back to the pre-COVID zone. And what we are seeing is that the capital formation seems to have reduced. You are seeing government is spending less. So obviously the capex from the government has decreased a lot, right? So if you actually go and look at the numbers, what the government had promised to spend in the whole year, they've not even spent like a 40% out of it, right? So there's a lot of money that they potentially could spend in the next half of the year, and that could be a big positive. But yeah, we have seen that slowdown happen, and that is leading to a slowdown in private capex also. And we are seeing government spending on the consumption side also slow down, right? So those are some of the reasons why we are seeing some slowdown in the domestic demand. And yeah, like I said, uh, India's capex growth rate has uh, like you can see that this is what they have spent and this is what is required for them to meet their targets, right? And on the capex side, capex means that how much the government is spending. You can see that is where we are lagging. But in terms of revenue, revex, which is the tax collection, we seems to be collecting a lot of tax, right? So again, you're seeing all this on social media as well. But yeah, I think the government still has to meet their capex target, and if they do it, we could see a significant boost in the industry. And if the government doesn't meet those targets, then we could see obviously the capex led industry sort of lag, whereas our consumption themes are getting stronger by the minute, right? So that is how it looks like. And obviously it's very unfortunate that in today's world, um, most of the market reactions are linked to government spending, what the US Fed is doing, and what the where the government is spending. We have seen over the last few years that all of us just jump to any sector where the government is spending, right? That is what is attractive. But is that how the economy is supposed to be? I think the real fun of investing, especially for people passionate about the market, is to find out companies that are doing something exceptional, that are highly productive, that are not running just based on liquidity flow. And I think in the current environment where we're seeing some slowdown in capex, that is where the investment will happen. People will go to companies which have real productivity instead of liquidity led growth. And that is where potentially we would hope, or I would hope, that the economy goes to, right? But yes, so we talked about quite a few things that have lagged in the economy. And actually, if you look at a number of brokers who put out their GDP projections, you see everybody has cut down their GDP prediction for the next year to around 6%, right? And whereas the RBI's projection is still 7.2%, so there's still a little bit of a mismatch. And maybe if the RBI cuts down those projections, we could see some under reaction by the market as well. But yes, there are a few things which are positive as well, and which make us look positively at the next 6 months, right? So one big positive is again on the consumption theme, which is that the wedding season is happening, and wedding season is a massive industry in India. And this time we are going to see one of the highest number of weddings and billions of dollars being spent in wedding linked industry. So that is a big theme to invest into. Secondly, we've seen very good monsoons. Monsoons have been amazing last year. So the agriculture sector is doing really well. We've seen India's uh, expenditure shift a little bit towards the agriculture segment instead of the instead of the infrastructure segment, and that is also leading to growth in that space. Plus there's a pickup that is being seen in the rural demand. So while we've seen a little bit of a slowdown in the urban demand, the rural demand is picking up. So if you were to pick up stocks, I would assume that if we are picking up themes, obviously the consumption themes or premiumization theme linked to the wedding season. We've done a video about it, you can have a look at it. Also, the agri linked stocks, agrochemicals linked to good monsoons, linked to good rural demand might be interesting once you look at. Similarly, we're seeing a small uptick in two-wheeler sales and all that as well, which is a strong cue to look at. So this is one big theme that will have a positive implication in the next half year. And second, obviously, like we said, that capex has been less, right? So will the government match the capex target, or will Donald Trump play spoil sport? We don't know, but if the government meets the capex target, then you could actually potentially see the next half of the year be very strong for the capex linked stocks, or the infrastructure and all those stocks where the government money comes in. And I've been hearing analysts say that there's noise that government is going to start spending more. So that could be again another big cue that something positive is going to come out, even though the global things to look at as well, right? Obviously, another big thing that has happened is the elections, right? So in terms of elections, we've seen in Maharashtra, the BJP linked coalition has won. In Jharkhand, the Congress linked coalition had won, and we've seen some positive reaction happen after the Maharashtra victory. So not sure if you can attribute all the recovery to that election, but yeah, I think that has strengthened the mandate for the BJP in this key state of Maharashtra. What is a little bit worrying though is that all of these elections have been won due to a lot of these socialist policies where government is paying people money for financial assistance and all that, which has led to widening deficits, and might not be sustainable in a sense, or might stress out the budgets of different states. But that's how the election has played out in the last month. Another big thing that has happened is the Adani crisis, and again, we've seen these stocks correct very deeply and then recover. Now we've seen almost pretty sharp recovery in the last couple of weeks. Is it permanent? Is it temporary? It's very tough to say. What I would recommend is that we should be very careful of these stocks. Big US case has been sort of formed against these particular companies, and until unless you know for sure what's going to happen, I think there has to be big you have to have prudence in how you sort of invest into these stocks. What we've seen is that some of these if you look at examples historically, what happens when the US Department of Justice does an indictment. So there are various instances of some emerging market companies, if you go and look at it, where such large cases have led to bigger implications and multiple such legal troubles and liquidation of companies. In other times, what we've seen is some very heavy fines have been paid. So for example, when there was a case that was fired against Goldman Sachs in 2012-13, they paid $2.9 billion as penalties. On the other hand, if you look at, there was a violation that happened by a UAE led group called Abraj Group, and when that happened, that led to the firm's liquidation. Uh, Similarly, we've seen Petrobras in Brazil, right, where the state-led company was in the middle of a big scandal, and that led to a lot of indictments and substantial financial penalties. Now, obviously, there is a political implication to this case as well, and you don't know what happens after Donald Trump comes, and but yeah, I think there has to be caution that should be linked to these stocks for sure. Now let's talk about the earnings, right? See, I think even on the earnings front, if you look at it, earnings have not been encouraging at all, right? So if you look at the profitability growth, the top line growth, you'll see we are quite near the bottom of the past few quarters, and we are reaching the pre-COVID lows. The market was not extremely bullish before COVID, and the liquidity came in, and we are reaching close to that pre-COVID level right now. what we're seeing is that while margins have been robust, so we've seen some correction in top line and bottom line, but margins have been robust. But what we also see is that the credit cost and the input prices are bottoming out, which means that margins don't have any potential to grow more, and they might in fact decrease if these prices rise, right? So that is again another thing to look at. And what we are seeing is that similar to our GDP forecast, a lot of earning estimates have also been cut down, right? So in this quarter, what we've seen is a lot of analysts have downgraded the earning potential of a number of companies. But what's interesting that is happening, and which is something important for us to take a note, is that while before this half of this year, we saw that earnings were very biased, right? So you were seeing industrials and autos do extremely well, and FMCG, IT, and all those stocks are lagging, and there was a big divergence in those earnings. Now that reconciliation is happening, therefore the slightly defensive stocks, for example, FMCG, IT, pharma, consumer goods, even though FMCG has seen some slowdown, we might see more recovery coming out there. And consumer durables have continued to be strong, so that normalization is happening. Therefore, our tilt has to happen more towards the defensive sectors. Also, another we are at a very high valuation in terms of, if you look at the NSE 500 valuations or the price to book ratios. And what that tells us is that if our valuations are very high, then our next 5 years tend to be slower in terms of CAGRs. Now, how will our valuations increase if the slump in earning recovers, and people expect that in the next 1 or 2 quarters we could see that slump recover. So so in terms of our understanding, what we're seeing in our portfolios is, we don't see any big worry as such. We see slow recovery, and from these levels. And what we see is that the focus has to be a little bit defensive until unless the capex comes back from the government side. Now let's look at the US economy. If you look at the US economy, what you will see is that the US Fed has cut down rates couple of times now, once before elections, one right now in the last in November. And we expect them to cut down rates further. But with Donald Trump coming in, we are seeing that US Treasury yields are rising rapidly, because people expect Donald Trump to be inflationary, right? He's going to take some very aggressive measures that will lead to probably slightly higher inflation. And he might want to get the Fed rates to be cut at an accelerated pace. But given that the US Fed chairman is independent and might not agree with the government policies, we could see slower rate of rate cuts as well. Talking about India, I think in India the inflation numbers were also really bad. So while GDP hasn't been that good, but inflation was also bad. So RBI has a big thing to think about. Will they try to boost growth by cutting rates, or will they try to control inflation by keeping rates higher? But a lot of analysts think that December will be, they might not cut the rates in December. uh, but yeah, see, if you look at the global markets, again, liquidity that is out there is a thing of worry, right? So the if you look at the US government debt to GDP, and these are the two things that whenever people talk about Warren Buffett is holding a lot of cash, and there's some signs of worry in the global economy. These are the some of the things that are a worry sign, right? What you can see is that the GDP debt to GDP ratio in US is extremely high, until and unless they make some measures to cut down their debt and control the liquidity. There could be some very worrying and volatile times in the US economy as well. So that's the long term view that many investors would have. But yes, in the short term, what we're going to see is tariff wars and tax cuts and all that, which will lead to higher yields and higher dollar. And if you look at, when Donald Trump came in and cut down the tax rates in 2017-18, you would see that the US dollar inched up. Your uh, yields also inched up when that was going on, and that could again happen if Donald Trump has those policies. And if that happens, our valuations are at a higher level. At that point in time, we were at a much lower valuation, and when that happened last time, what we saw was that there was some correction that happened when Donald Trump put out those policies. But what is interesting again is that while the correction that happened was in these cyclical sectors, the defensives continue to outperform. So that is what we are seeing right now, that uh, higher potential in the defensive sectors and more bias towards defensive sectors, because there could be worry from the growth rates, from what's happening in the policies and the slow capex by the government. And that is where our allocation is shifting, and we think that, like I said, it's a great time for us to focus on companies that are consistently profitable, who are making good use of their cash flow, and are not just surviving based on the liquidity. Um, and that is what the models are also picking up. So that was a quick presentation on what I think about the market. Let's go over to the questions next.
Sure. So I'd recommend everyone to just keep dropping their questions. We'll sort of take them one by one. The first question I have here is one on from Squid Bhai on U.S. elections, and then the other one on Adani stocks, given that they've somewhat of a recovery has happened in the last 4 5 days. So, any sort of overall thoughts on Adani and post U.S. elections, how the market has been doing?
See, I think post US elections, the US market definitely has been doing well, but Indian markets hasn't done that well, right? I think money has just been flowing out of India to the US because people expect the dollar to be stronger, and the America first policies to favor America, right? But
Yeah.
yes, I think after this reaction that happened during the Adani crisis, after the news came out, we've seen some recovery happen. I think potentially the cue was the Maharashtra election, right?
Yeah.
But I think we were a little bit overdue on the recovery, and because see, there's no, I mean, we are seeing some slowdown in terms of growth, but there's no big reason for us to go through a 15-20% crash, right? I think
Yeah.
we are still in a robust economy. So we expected the recovery to happen, but will this recovery be very sharp? I don't think so. But I hope it is slow moving, and potentially high quality companies sort of do well.
Sure. And I think just sort of following up from that, there's a question from Sadiq Ahmed where he's talking about the economic slowdown that the Indian economy is sort of kind of seeing over the last maybe a quarter or 2 quarters, probably.
Hmm.
So any thoughts on that at a very high level?
See, for sure. See, I think rates have been high, Siddharth, in India, in the US, right? Which always, so everywhere the central banks, have been trying to reduce inflation, right? So we
Mhm.
came out of this big COVID crisis, which led to a lot of liquidity flow into the market, which has led to a lot of us getting rich in India also. But that doesn't mean that that liquidity will keep on flowing forever, right? Financial markets is a closed system, right? And right now what we're seeing is, and that high amount of liquidity led to a lot of inflation, right? And inflation means a lot of pain for the economy and for the public. So the central bankers have been trying to reduce that inflation, and whenever they try to reduce inflation, that comes at a cost of growth.
Yep.
And that is what has led to slower, little slowdown in terms of growth. And like I said, capex has also not been there, right? And that is seeing some impact. But India is we, like I said, we don't like to tell stories, but India does have a growth story where it compounds at a rate higher than 6%. We
Yeah.
would expect recovery from here.
Sure. And so again, just because this is a follow-up question that's I can see on the screen, this is a question from Finance Guru where he's saying that recently, I think we also put it out, and there was some analysis in the market talking about the 200 DMA being breached. So his question is, could the correction be over sooner rather than later? Or just again, high-level thoughts on that as well.
See, there are two ways to look at it, right? I think in a very organic sort of correction, crossing 200 is a big support, right? And we've seen recovery happen after that only, right? We
Yeah.
touched that 200 EMA, and that led to a support and some recovery.
Yeah.
That is one way to look at it. Ki 200-day was a support. Second thing to look at it, Siddharth, is that like we talk about regime models a lot, right? Is it a bullish regime or bearish regime? And typically, wherever prices go under 200 DMA, some people assume that the bearish market has started, right?
Yeah.
So it is also a sign of worry in that sense. And given what's happening in the economy, we have to be careful in how we look at it.
Sure. Just sort of shifting gears here, we've got a question from Chetan Sakharkar. He's asking about specifically Right Titan, where the original theme was focusing on large cap stocks. He's just wondering if there's going to be a shift from that to a wider, market cap, or some sort of a different flavor to things there.
No, not really. We are still into large and mid caps, right? So I mean, our definition of large and mid caps would be that we are investing into stocks with more than 20,000 crores in market cap, right? So, some of them might be categorized by, there's an AMPI list that comes out once in a 6 months, right? Which reads these stocks as small, mid, and large. And in this list, you might find some of them being categorized as mid caps, but these are all larger stocks with more than 20,000 crores in market cap, and that's what we are going to stick with.
Fair enough. Just sort of talking about the PMS as well. There's a few questions, quite a few questions on it. I'll sort of take them up individually. One of these questions is from Sashi Bhushan. He's asking how many shares do we typically keep in a PMS portfolio?
So we would typically keep around 20 to 25 in our factor and our momentum strategy. In our alpha strategy, we only have 10 stocks.
And just sort of following up from there, there's also the sort of news in the market talking about a small PMS, mini PMS. Any thoughts on that beyond the sort of whatever's available publicly right now?
Yes, so see, I think it's a very interesting proposition, but very unfortunately, we will not, like, as investment managers, we will not have access to that structure. That structure right now is only accessible to mutual funds, right?
Yeah,
So what will happen is that a mutual fund, which might be having a small and mid cap fund, now can create a slightly leveraged small and mid cap fund, or can add some hedges or some sort of leverage to it. Um, which will be interesting for investors for sure, but it will be the same people who've been running these large AMCs will be doing it. So not very sure about the amount of innovation that would come out through those structures, because
sure.
we see more innovation happening from the smaller and the upstarts.
Yeah.
So yeah.
Fair enough. Again, there's a few questions from Sadiq Ahmed. I'll try to sort of bunch them up. One of them is where he's talking about specifically a factor fund. If you can talk about the current factors that you see are going to do well. And then the second phase of that question is talking about the potential churn rate that is there in momentum fund. Do you see that increasing or decreasing in the next quarter or so?
Yes, so the first question was,
On factor fund, just what factors do you think are
yeah,
doing well?
yeah. On factor fund, what we see is that our focus has been on a mix of mom- momentum value till a few time ago, and now it's a mix of momentum value and quality. And momentum is also getting stronger, at least in the last 1 week. We have to see how sustainable that is, but that's what we are focusing on right now. Like I said, we are in a risk off scenario still. We have not gone full risk on yet.
Sure. So just to again mix it up a bit, I'm just going to take some of the earlier questions. One of the questions is from Aditya Ravi, where he's talking about, I think he spoke about fear and greed index and how you're using that to invest. He's just wondering how do we measure it? Like, what are the some of the parameters he should consider? Um,
Yes, so we create our own fear and greed index, and it is so there are few, like there are 5 6 indicators that we look at. One is just a simple momentum based on moving average. How much is the market above the moving averages? Second thing we look at is what is the number of stocks that are hitting the 52 weeks high versus number of stocks that are hitting the 52-week lows. We also look at something called advanced decline ratio, or the market breadth indicator. How many stocks are rising versus how many are falling. That gives you a idea on the market breadth. We look at the demand of gold versus equities. We look at the demand of bonds versus equities. We look at the market VIX levels, right? We create an aggregated indicator of all of these levels, and that is what we call our fear and greed index. But we have tested it out in terms of allocation historically, and what we've seen is that if you're buying in fear zones, and if you're actually not buying that much in greed zones or cutting some positions in greed zone, that tends to be a very smart strategy.
Sure. And again, sort of talking about the PMS side of things here, there's a question from Aishwarya Gupta where they're wondering, within the PMS structure, do you think it's the right time to be adding more capital given the current context of things? And typically, how much of a how much percentage of cash would you recommend or think about in terms of adding on in these sort of correction scenarios?
See, I think, like I said, whenever we are in a fear zone, that's the best time to actually invest, right? Because markets also tend to be mean reverting, and you could see stronger numbers coming whenever you're adding in the fear zone. So we've seen many investors add capital, and people also ask our individual queries, that is this, should I be adding capital right now? If I have money to invest, we tell why not. We actually uh, invested from Wright Research's account also over the last week. So, we are actually sort of, we think it's a good time to invest, and because we don't see any specific large pains until unless the tariffs that come out are very very aggressive. It could be a good time to invest and see. Like I said, our allocations that is heavily into defensives, right?
Yeah.
So we are not that worried about the economic strain that might happen. We've seen that economic strain play out uh, during the last quarter, right? You've seen the defense, railways, and all really really correct, right? But defensives have done pretty strongly, and that's what we see is going to happen for the next quarter. So we are very confident in our allocation, and we think it's a good time to accumulate and sort of add money.
Sure. So just sort of a follow-on question. This is from Mr. Agarwal 102. He's saying, obviously, we'd want to top up, and it might be the right time. But typically, what would be the deployment strategy that you would follow? Is it, the entire cash goes out in one go? Is it over certain time frames? And any thoughts on that?
Yes, yeah. So we don't deploy everything in one go, and in fact, people who invested in October and November, right? If you ask them, we have still only deployed 50% of their capital, right? We are, slowly accelerating the deployment over that. We've done accelerated deployment in the last week, but right now we've only invested 50% of many people, and the idea is that we would invest more when there is a fear zone and a recovery that seems to be forming, right? So we've seen, we've been in fear zone for more than a month now, but there hasn't been a tangible recovery yet, right? And we've seen some uptick, but will that sustain? Especially after the GDP number, that is to be seen. And if that happens, then we'll do accelerated recovery, accelerated deployment. But we'll typically take 1 or 2 months to deploy your capital.
Sure. So just going to again switch gears a bit, just so that we have a bit more flavor of questions. One of the questions is from Finance Guru again. He's asking about, do you think rural consumption will pick up? And any sort of overall thoughts on FMCG consumption sector in totality?
Yes. So see, I think global consumption, given that rate cuts are happening and they're trying to simulate growth in the economy, that could lead to more consumption, right? Again, the tariffs and all whatever happens through that, that is to be seen, and that's a little bit political, so difficult for us to comment on. On the other hand, FMCG segment, see, I think many people were really disappointed by FMCG earnings, and FMCG, you expect it to do well when the market is correcting or when this is happening. Scenario like this is happening, but FMCG did not do well, right? And some people seem to have given up on it. But I have a slightly contrarian view that even though we've seen some stress, rural demand is recovering, monsoons have been strong, and India is the massive consumption market, so FMCG should see some recovery from here as well, and improvements in earnings as well. So we have a slight positive bias towards that.
Sure. Again, on the similar themes, we've got two questions, one from Squid Bhai and one from Mr. Agarwal 102. Both one of them is asked about Ola specifically and EV stocks, and the other one is asking about data center stocks. I think we did a video on it as well a few months back.
Yeah.
Just any high level thoughts? Are they attractive still? Future outlook,
Uh,
etc.
See, I think with Donald Trump coming in, see, Ola Electric has had again a very fluctuating journey. It had an amazing IPO, then corrected a lot. We saw some recovery in the last week, and then it has given up some gains. And obviously, you know that that company has some specific issues, right, where a lot of returns and all are happening. So that's a different story. But looking at the EV industry as a whole, I would assume, you know, Joe Biden had a huge focus on sustainability and EVs, and you know he was a big proponent of that. Donald Trump will not be a big proponent of that, right? He is more biased towards the fossil fuels. So maybe the focus shifts a little bit from these stocks. But I think Indian government still has focus, and you know we'll see. We'll have to see how the capex shapes up for Indian government. But otherwise, you know, it's a potentially large long-term market for sure, right?
Yeah. Again, just going back to the PMS side of things again, this is a question from Mr. Abhishek. He's broken it up in two parts. The first part is talking about momentum being a factor within your factor fund strategy,
Mm-hmm. Mm-hmm.
and the fact that it's typically momentum may not do as well in a bear market regime, right? So he's just wondering, how is that sort of being accounted for? And then the second part is talking about what is the sort of churn for efficient taxation within the PMS strategy. So how either coming up with a new strategy or within the existing framework, how do you sort of handle a low churn?
Yes. So I'll talk about the first question, right? Like momentum and downturns, right? So what we've seen is that, like, if you look at the momentum strategy, what you would see is that momentum tends to underperform on shock days, right? Whenever there's a shock value,
Yeah.
okay, regime has shifted and there's a big shock. So you will see that people start selling the momentum stocks and they're not investing that much into that. But if you look at our momentum strategies, right, our PMS, momentum, and alpha, they have done extremely well in the last 3 to 4 months, right?
Yeah.
So it doesn't mean that momentum does not do well. There's a shock element to it. You know, whenever there's a shock, you would see that small caps and momentum stock they see bigger correction. But momentum is a very adaptive strategy. So let's say, so see, last year we were heavily, like I said, cyclical. Right now, Alpha Prime is almost, we saw that highly into pharmaceutical and consumption and consumer durables right now, right? So we don't think that momentum would have extremely bad time in a volatile market. And for our factor strategy, we have other factors there for sure, right? So like I said, value, quality are still doing pretty well, and we have allocation there. Second question you asked was on the taxation front, right?
The
So see,
churning. So yeah, they just said keep PMS strategy with a low churn for taxation.
yes. See, what we think is that it's an active strategy. It's not. We don't do passive investing, right?
Yeah.
You can go to a number of ETFs for passive investing, and see, whenever you are doing active investing and you look at any active manager, right? Typically, if you are looking at some of the best performing active PMSs, you would see churn very similar to ours, right? We are not doing any excessive churn in our strategy. And you look at the differential because of, so I mean, I have, if you guys would like, I've done it for a few clients where, we are comparing, for example, our strategy with some of the momentum ETFs or with some of the mutual funds, right, which are passive in nature. And this is for the live time, right? So I'll just show you this chart. See, if you're looking at comparing our strategy with some of these large mutual funds, you would see there's been a margin in terms of performance, right? You've done way better in terms of absolute. These are CAGR numbers, but in terms of absolute numbers, we've done more than 10% better than them, right? And so, on a this is on a pre-tax level. So, on a post-tax level, also we've done much better than them. And even on what I'm comparing with momentum ETFs, also you would see there's a big margin that is there, right?
Yeah.
So in the long term, if you're even able to beat the benchmark on a by 3-4% on a pre-tax basis, you're still doing better on a post-tax, right? So therefore, I think while there might be slightly, we are active strategy, the government is taxing short-term capital gain higher, so we'll have to incur slightly higher taxes, but still, we are doing better on the post-tax basis.
Sure. Again, just sort of talking about a couple of things here. One is from Mr. Arun Tiwari. He's asking about specifically sewage and water cleaning sector in general.
Yes.
And do you think that that is something? that could be in focus in the next current couple of quarters?
Yes, yes. I think somebody also asked about data center, right? So we've covered,
Data
I
center.
think, done videos. So I really enjoyed working on those videos, which is so we've done on data centers. Data centers is a very strong theme. See, due to the global regulations, we are seeing companies have to store data in India, and for storing this massive amount of data that India is generating, you need these huge data centers, and you're seeing companies from Reliance to Tata to everybody else investing into those sectors. So we do have a few data center stocks in our portfolio, that is for sure. In terms of water treatment also, I think India's water treatment has to become much more efficient, right? So we don't utilize our water resources really well. There's still a lot of need for sewage treatment, recycling, and all that for us to grow. Otherwise, we'll become water deficient in the next couple of decades, right? So there has to be a lot of investment in that sector, and we have a lot of interesting stocks like Baba, Gaia Exchange, etc., which are there in these segments, and these are very good potential long-term buy stocks.
Sure. There's a question here from Jayanta. They're asking, there are no IT stocks specifically within the Alpha Fund, which could capture the dollar weakness that we might be seeing. Any thoughts on that?
Nitin, I think it's very interesting. We still don't have any IT stocks in our portfolio, and uh, they are just flying under the radar for some reason. And I think, like, we have recently added quite a few, let's say, IT linked stocks. So maybe stocks in the e-commerce and fintech space, which are also linked to the IT industry. But we don't have specific IT stocks, and we'll wait to see when those come up in our model. Like, we don't have any IT stocks, uh, or we have like some very small exposure to IT stocks, and we don't have any private sector banks also, which is very interesting.
Yeah.
Yeah.
There's a question here on a macro level from Mr. Sadvik again, where he's asking the effects of fiscal policy that China has been sort of working on, which have obviously had an impact on the FII flows, etc., within the Indian context. Uh, Again, do you think that is something that will continue to happen over the next couple of quarters?
See, I think obviously fiscal spending is happening, and that leads to short-term boost in sentiment. But does it lead to long-term growth? And I think people are right now getting a little bit, disillusioned by this government spending, right?
Yeah.
Because that leads to a lot of easy money coming into the economy, some short-term movements, and then we've seen inflation come up, growth not be sustainable, and lot of debt levels like rise in the US and all that. So uh, and China being a very communist country, how will that socialist policy sort of help the government spending? That has to be seen. But yeah, I think if there is a stimulus that comes out, that will lead to some short term reactions for sure. But we've seen that it hasn't sustained, right?
Yeah, yeah, it hasn't sustained right now. There's a question here. This is a specific stock specific question. So it's about Enviro Infra. One of the investors, Mr. Priya Ranjan, is asking, is it something that you would, just your outlook on it, without getting into advice, so to speak?
Okay, so it seems like a very small stock. It's recently come out. Okay? Is it just
Yeah, yeah,
IPO?
he got it in his IPO. That's what he's mentioned.
Okay.
Just high level thoughts, if any.
Yeah, so I think it's a small stock, seems to be having a strong profit growth and strong sales growth. It's in the infrastructure space, which is very interesting for sure. Uh, and you could see potential performance out of it, especially the name tells me that they are in the environmental space, wastewater treatment, and all that. So it's a great sector to be in, and if you got it, I would hope that you hold on to it for some time before taking any short-term calls on it.
Sure. There's a question here from Mr. Pradeep Khare. He's asking about, again, top up, similar on the PMS side. Um, Again, how should they go about it? When should they sort of think about it in the next 3 to 6 months?
So I think next 3 to 6 months will be the best time to accumulate capital into the market, right? Because we expect growth to recover after a couple of quarters, right? Growth to really recover. Until then, we might see sideways or slow growth, right? Which will be the great time for us to buy. So even I was talking to somebody, and I said that you could start buying right now. Like, we are seeing many people who are buying right now, or you can do like a 6 month SIP that I'm accumulating at these low levels. I'm not so there. You're not trying to time. Okay, Is
Yeah.
this month the bottom, or is the next month the bottom, or was the last month the bottom? If you just do SIP every month for 6 months, you will have bought at a very good price. Right?
Sure. Within the PMS structure, what is your rebalancing frequency? Is what Mr. Sachin Kayapure is asking, and specifically within, let's say, alpha and factor fund.
Yes. So see, we typically rebalance on a monthly basis, right? There's a monthly rebalance, but it's not on a specific date. It's not like, on the first of the month that rebalance would come. It happens during the month. You'll see two or three stocks would change, right? And that's how the rebalance sort of goes on in our portfolio. So you can assume like a monthly churn where two to three stocks are changed, but it's not on a specific date, right?
Because it's an active strategy naturally. So Mr. Sahai is asking about the HNI quant, and I think it's a question that could extend beyond for, I suppose, all the portfolios, PMS and non-PMS, where he's wondering when is it that we typically decide to cut the stock, since in his case he might be seeing some of the stocks have more than 10% but are still continuing in the portfolio.
Yes. So see, 10% is not the only indicator, right? In the last quarter, you've seen so many stocks correct more than 10%, right? Almost every stock has corrected more than 10%. So that might not be the best way to judge. What we have seen is that obviously we've rebalanced HNI quant recently, right, in the last month, and what you have seen is again even there the tilt has happened more towards slightly defensive stocks compared to maybe some very aggressive. What we have cut down is the more aggressive allocation, right, and gone more towards the defensive stocks. And yeah, see, we will not try to time it. 10% cut, so 10% correction, so let's cut that stock. That's not how we operate. Typically, what we look at is exposure to different factors. HNI quant is a combination of momentum, estimates, and other factors. So if the stock sort of starts ranking lower on those fronts, then we'll cut it.
Got it. This is a question from Samya Durai, where they're asking about the fact that we may have be holding on to some gold ETFs within the PMS structure. Will we be moving that to equity? Is it just to sort of park capital? Is there a gold play that we're currently doing? Just high level thoughts.
Yeah, so I think gold is more like a hedge for any sort of pressure in the economy. And we've since we've added gold, we've not seen much movement. Gold has seen some correction, in fact, in the last 1 month, after having a very good run since August. But we're still holding that small gold allocation. We might cut it somewhere in the future, but our models are still hinting at some gold allocation.
Sure. Um, there is again a stock specific question. Within Alpha Prime, there's a stock called Godfrey. They're wondering why are we still holding that. This is from Mr. Future King.
Yes, so yeah, I think we did a very interesting shift. I think in Alpha Prime we had cut down our Trent allocation, if I'm not wrong, right? Which was some people tagged me on social media also and said what's happening. Uh, so that was one thing. But yeah, I think Godfrey has also seen some consolidation, and you don't never know what's going to happen in the next rebalance. It's going to come tomorrow.
There's a question here from Mr. Viral Jain. I'm presuming it's for PMS, so we can maybe take it in that context. Where he's wondering, can we move from one theme of our funds to another theme uh,
Yes, you
within the
can. You
PMS?
just have to inform us, and you can discuss with me and my team, and we'll do that shift.
There's a question from Mr. Yogesh Jain where he's wondering about your views on metals or commodities, given that Trump's inflationary policies could lead to some sort of an impact on those prices.
Yeah, I think if these massive tariffs that he's talking about, he's already talked about adding tariffs to Mexico, Canada, BRICS nations, and everywhere. So that will lead to some spike in commodity prices, which will lead to inflation, and there will be a lot of interesting things. I think there will be a lot more unpredictability in the market once Trump comes. But we have to watch out for it, right? So nothing is set in stone right now, and we'll see how things shape up, right?
Sure. I have probably just two more questions this on him, and then we can probably wrap up. One is from Mr. Rakesh. This is an earlier question where he'd asked, how much returns can you expect over the next 1 year?
See, that's a very difficult question to answer, right? But see, I think from the market, our expectation is, you know, maybe 10-15%. And if that happens, we would expect better returns from the PMS. But difficult for us to put down hard numbers.
Absolutely, and I think we've just so one of the viewers has just commented from Mr. Sri Harish Popuri. He's just mentioned that the last 1 year was phenomenal for us, as a fund, so to speak. And is it that we should expect as investors similar things to happen in the next 12 months, or do you think it'll be more of a moderated year?
So I think it's a different year from last year, especially due to the slowdown in earnings, and secondly because of the high valuations which are still there, right?
Yeah,
Which is what history will tell us that leads to some slowdown in terms of performance. So that could happen, but you never know. I think markets have now very dependent on government capex and what's happening with the central banks, and you have to see how the reactions will come.
sure. And I think this is the last question that's there, and it's probably the theme of today's conversation, based on what we've seen from the questions. This is from Mr. Agarwal and from Mr. Viral. They're asking about top ups, the recommendation of doing top ups, and having maybe a more proactive approach as well. So, just final closing thoughts on that.
Yes, yeah, I think you can top up, because especially in the PMS, because we don't deploy your money on day one after you've topped up, right? We will sort of try to deploy it as per the changing market conditions, and into the new set of stocks that come in instead of the older set of stocks. So that's the better way to sort of invest. And so
Sure.
yeah, so you can top up, and like I said, that we also invested from the right research account in the last week itself, right? So we think might be a good time to invest.
Sure. And just again, just because it's just come in the comments here, when we were talking about the 6 month top up cycle that we would do typically, or you were talking about, people can do it. Is that an SIP that they can do within the PMS structure? Is it something that they just need to do automatically? Just last sort of thoughts on that.
Yeah, you can do an SIP. So we have few investors who do SIPs, or you can top up anytime you want. So whatever suits you, you can do that.
Sure. I think that's it for today. I think we've got pretty much all the questions that were there. We probably covered pretty much all of them at this stage.
Amazing, great job, Siddharth, and thanks a lot everybody for joining. We had a lot of fun, and hope to see you again soon in our next live stream. Have a
Thank you,
great
guys.
Sunday.
Take care. Bye.
Done.